So the work I'm going to present is joint work with my student Meng, Tian. She's actually in the job market, and this is part of her dissertation actually. Okay, so let's just get started. So when teaching this options pricing class, right? So then people talk about Black-Scholes model, they win Nobel Prize, and where their contribution is, right? So to me, actually, I feel like the biggest contribution is not necessarily in the option pricing formula per se, but the idea of dynamic hedging, right? So if you think about it, originally, what this model or what their theory has done to the market, right? So before that, if you write an option, it's like writing an insurance contract, which is sort of highly asymmetric and highly risky. Right? So the risk premium you receive is tiny, but the risk you face could be rare, but it can be very, very large. Right? So for insurance company, they deal with this risk sometimes through diversification. For example, when we talk about a life insurance, right? So if you sell insurance to a large population, you are turning probability into a proportion, right? So the risk becomes deterministic, right? But for options, it's harder to do that. Then without the hedging idea, what you can only do as a market maker, for example, is to try to keep a balanced book. If somebody wants to buy option, you need to find a counterparty to want to sell it, right? So it's pretty much like I call it a bookie for a sports gambling event, right? For the bookie, it's important for them to change the price quickly to balance the book. Otherwise, they're in trouble or they are forced to do something tricky, right? And this naive bookie strategy actually severely limits the size of the book because you have to balance it. So what this black merchant shows model does is that they say under some assumptions, we can replicate the payoff of the option through dynamic trading of the underlying security. And by doing that, you essentially, through this hedging, you don't need a balanced book anymore. You on one side you can have some order from the options. On the other side, you can use this trading of the underlying to sort of balance the book. That's how it expands it. And not only that, I think before their model, we are normally thinking from a static mathematical perspective. Right? We're thinking if there are two states, we need two instruments to hedge. If there are 10 states, we need 10 instruments. But since there are infinite number of states, then we need infinite number of instruments. So the quick insight here from their model is that we can use quick motion over time to cover space, right? There's a kind of time-space replacement, right? So I feel like that's the key insight of dynamic hedging, right? It's almost like playing basketball. If you are fast enough and the player in front of you is slow, you can do man-to-man defense, right? You can cover the whole court, essentially. Just follow that guy with you, you in your hand. And that's essentially like dynamic hedging, what dynamic hedging is doing. And if you're not that fast, I guess you need to do zone defense. That's like a static hedging. You need to put all the people there, right? So I actually think that idea is very sort of revolutionary. And with that, being a bookie for derivatives can make a much larger market because you can handle demand asymmetry. Actually, a few months ago, we were trying to work through to see if we can set up a sort of a bookie site for stocks, right? Because essentially those upper and unders are binary options. And I checked the binary option bid-ask spread. We use the largest spread versus the bookie they charge you. We know the bid-ask is very large for options, but they are much smaller than that for the sports betting side. If you go to the sports betting side, all the kids like to do it actually, right? It's like entertainment. The bid-ask is huge. They don't show it as a bid-ask, obviously, right? They show these two sides, how you enter, how you close. But it's mainly regulatory. There are lots of patents on this actually, right? The reason actually we can make a better market is because if you book market making on a sports event, you don't have an underlying, right? You need to keep that symmetry, and you need to charge the spread to make sure that you don't get one-sided. But when we try to be a bookie for the a stock, because this underlying stock is tradable, that can really, you don't need to have a balanced book anymore. I think that's the big part of this their insight. I feel like it can be used in many different places. And we know that their assumptions are very stylized, right? So they're assuming that the trading has to be free and frictionless, and the underlying stock movement has to be in a particular form. It's continuous. It's like a binomial, right? It's very like that. In practice, there are many things that can break down. For example, trading stock has a cost. Small, large, there's a cost, and this cost actually can increases with size. When I was working with a market options market making desk, more for institutional options market making, uh, this trading cost becomes a huge issue because we normally get these large size orders on options. Say Apple is so liquid, but you get these like millions of contracts on call options on Apple or something. And normally the counterparty does have some information, at least some alpha, right? Because when we measure the flows from the, on average, they have a sharp actually is 1 or 2. It's very high actually. But so how do you make money? Obviously, you charge a spread, but you need to do your data quickly because their information is on the direction, right? But when you do data hedge, even on Apple with that large size, and you have to do it quickly because you worry about the information, right? And the trading costs can be very high, right? So it is a concern. How do we do the hedge? Can we hedge half? Do we dare to hedge half? Can we use index futures to do beta or something? Is kind of a constant discussion. And the other issue that we all know is that in order to implement a delta, you need a volatility input, which we don't know, right? And the vol also can change over time. That induces another source of risk that you not only changes the delta ratio maybe, but also you really just cannot remove the risk anymore. Right? Many years ago, Gurdip and Modan has that paper talking about delta hedged option returns, both calls and puts. Their return can go up and the ball going up and down. That's sort of capturing that idea, right? And the worst case, I guess, is when the price can have jumps of random sizes. When this is when the sort of hedge breaks down, and it's very hard to handle. Many traders sort of try to ignore these and or put this into a spread that is your charge, and just focus on the part you can hedge. Right? So my sort of reference is if you do man-to-man defense, it only works if the guy is not Michael Jordan, is slow. Otherwise, if it can flies fast to different places, you cannot do that anymore. And that requires you to put 4 or 5 guys on top of it across different places. That's called static hedge. Right? So not only that, and especially during recent market events, we see some things that go crazy, right? So that is for if the underlying is not liquid, then delta hedging of a short operating position itself can impact the security price in somewhat of a self-exciting manner. I think many years ago, people talk about portfolio insurance, its contribution to the market crash. And recently we have the GME, the GameStop stock example, where people buy these call options, which is driving the stock price up, those kind of things. So in these cases, actually, normally we're thinking of derivative as derived, as secondary. But in this case, it's the trading of the derivatives that are moving the stock price itself. So essentially, you're saying the tail is wagging the dog, right? Then it calls the question on what is primary? What does it mean to be primary? Or what is derivative? What is derived, right? Or secondary, right? So if we flip that story, right? So we know there are practical limits, so that the hedging cannot be like perfectly done. So there are going to be remaining risks. But these remaining risks, all these practical limits actually give us a sort of a existence role for the existence of derivative securities, right? Because in our classic option pricing theories, we use dynamic replication to price options. Then as options are redundant, you wonder why they exist at all, right? But here, actually, they can have a sort of a purpose now, right? They can play an active role in risk allocation. When we talk about the risks that you cannot take or you cannot hedge, means you cannot take with the primary markets, then you can take it through options, right? So there is chances that you can proactively seek these risk exposures through derivatives because you cannot do it using the underlying. And you can say what we want to do here is really trying to focus on this part. First, we can say how much of the risk can be hedged through delta hedge. Right? If it's delta hedge, then yes, that's the primary market. If you can hedge it, you mainly deal with the risk return relation on the delta exposure through the stock market. There are tons of literature on these stock exposures and what kind of risk give you what kind of return, that kind of stuff. But after that, the remaining risks essentially are the primary rules for the existence of derivatives. So if we want to understand sort of the derivative market, I feel like we need to go beyond our no arbitrage pricing models, but instead to understand what kind of risk allocation role they can play, and how much investors charge premium for that, right? And sort of the design or existence of the derivative market should be mainly driven by these risks, right? By gaining exposure to these risks. Right? The derivative pricing, the dynamic arbitrage pricing method actually is sort of ignoring this role. So based on this sort of motivation, we essentially have two parts. First, we just check how much risk we can get rid of through delta hedging, right? And after the 2009 financial crisis, in the literature, in the industry at least, there is an outcry against quantitative models, saying that these models are wrong, they lead to financial crises, they don't work. So I guess here we want to give a quick check, and Peter has and I have done this a while ago on the index options. Here we want to do a more sort of comprehensive analysis to see how effective delta hedge can become, right, in removing the risks. And that sort of is the contribution of the quantitative theory, right? But after that, we also want to understand the nature of the remaining risks, right? The nature of what I call the primary risks in the derivative market. What are they, and how do option investors price them? So these analyses are sort of somewhat synthetic, right? Because there are many papers on option returns, and also preliminary in the sense, how do we define these risks, right? Try to think it through. What are the risks people are trying to gain through options trading and options investment? And how do we measure these risks or risk exposures, right? Then we do sort of a analysis on that. For the literature, I guess we have two parts, right? One part is on the hedging effectiveness. The other is on the risk-return relations. There are many papers on hedging, but most of them are like either on more comparing the performance of different hedging methods, right? It's very difficult to find an absolute number on the percentage variance reduction. Many papers on root mean squared errors. I have written with Peter a few papers on different hedging strategies. So I went back to the papers. I cannot find in absolute terms how much variance we're reducing. We can only see one method is a little bit better than the other method in relative sense. Right? So we try to put in that number. And Steve, many years ago, he actually had read a paper to show why the delta hedge can break it down. And he has some numbers, but it's very hard to see it from his own paper. I guess when I talk to him, he has to go back to dig out these numbers, trying to back out a percentage number, how much is reduced. And a few years ago, Peter and I did this short exercise on S&P options to sort of get a percentage number on how much risk you can reduce on S&P options. So what we do here is more like a extension of that analysis across individual names. It's getting harder to do. On the risk-return relations, I did put a list. I'm not sure it's complete. And in the paper, we have a list of these papers. And if you have known or you have a paper of yourself on option returns, please let us know. Right? It's either related or it may inspire us to sort of define different risk measures, right? Even if the paper is purely, you just find some return behavior, then it's good to sort of analyze and see what's driving it, okay? So here we are trying to put them together and trying to sort of define risk measures and link it to return compensation. But what we're not trying to do is trying to identify a option trading strategy or anomaly. Say without knowing the source, right? Just trying to identify a strategy, for example, through high frequency trading or through full valuation, for example, right? You do some valuation, you have a pricing error, sure, you can trading on pricing error. That's universal across all asset classes. Doesn't really matter. It's derivative, bond, stock, right? You can do that, but that's not telling us much about the so-called primary risk source, the risk exposure, and the risk premium compensation. So that's not our focus. Like momentum, for example, also. We're trying to find some structural risk exposures and link that to risk premium. And before these literature, there's also this ton of literature of using options to extract information about the underlying, right? There, you're not talking about the primary role of the options market, more talking about the overlapping role of the options market and the stock market, right? So you're saying the option market also has information about the underlying stock and so on. There's a link-like relation. And we also, Peter and I also have some papers about the linkages between options and credits, for example. So there we all talking about overlapping markets and the linkage across different markets. Here we're more focusing on the existential purpose of a specific market, right? It has to have a primary role for its existence. And what are the primary purposes? Okay. So the data is reasonably simple, option matrix from 96 to recently 2019. And we choose one date per month to calculate option returns. Meng is very careful. It's like when I have been thinking about doing this for a long time, but just doesn't have the heart to really process the data. And she's get the data nailed down quite nicely. So we pick a day per month so that the front month option has exactly 30 days to expiry, so that you can create a sort of a 30-day return series in that sense, right? And some generic stock option filtering criteria to make sure that the numbers are reasonable, are not dominated by bid-ask spreads and so on. And for each stock we choose, we pick an option contract closest to the target. For the manual analysis, we use 1 month at the money option, so you get the 30-day option, and then pick a strike closest to the spot to get that. Right, that's the main filtering criteria. So we get about 6,000 companies, that many observations. So the universe is about here. I just normally I like to draw a graph to see how big my universe is. The average is about over 1,000 companies, a little bit smaller in the beginning, right? 500 companies in the beginning. So that's the universe. The analysis is mainly cross-sectional. So the size of the cross-sectional universe is sort of useful here. So to understand the hedging sort of effectiveness, we define returns on the 30-day option in 3 different ways, right? With different hedging strategies. We sell the option, right? Sell the option, hold the option for 30 days, right? And no rebalancing. And the idea of choosing a 30-day option is really, I know we're not doing trading strategies, but if you think of even the option market maker, many times they also get stuck with the option position. So dynamic trading on the option is extremely difficult given the bid ask. Right? So I want to set it up also just so that I only need to sample the option once. And even sampling them day by day is just a difficult task to make them correct. We did this exercise on S&P. It's just very hard to do. So we choose a 30-day option, holding them to maturity. That gives us some, at least we can calculate the naked return in a very simple way, right? You have today's option price. You don't include it in your universe unless you find the price sort of reasonable, reliable. And then you hold it to expiration. If you hold it to expiration, we can just replace the expiration price with the payoff, right? Assuming these options are not exercised. I think we exclude distribution, stocks with distribution within a month. So the early access chance is low. This is an approximation, but so that gives us a way of just using one quote from the options to calculate the naked return. Then for the second strategy, I still try to reduce trades, right? So here we put on a delta hedge at an initiation. So this is quite doable for most names. You sell the option, then you find the delta, then just hold that delta through the option horizon, right? That's for like 30 days, right? An alternative of doing this is to, if you're trading two options, right, put call like a straddle, and if the straddle is close enough to the middle, the delta left is very small, right? In principle, you can get a delta neutral straddle, but here, because of the strike choice, it may not be neutral. Then you only have a small delta left after the combination. So the hedging becomes a sort of easy and the cost is low, right? So we just hold this to expiration. Then the last one, we try to do daily data rebalancing. When we did this for S&P options, S&P index options, I process the data very carefully, and sort of we try to map the numbers across the names, making sure that every day we have the valid quotes. Here, when I was discussing this with Meng, we try to simplify it a bit and to reflect the possibility that some names you just cannot trade in the middle. It's possible. So we call it daily data hedging, but it's whenever possible. That is between these 30 days. At a certain date, you go to that database to see whether you can find the option price or not, whether the option price is available or the data calculation is available. Sometimes the option becomes far in the money, far out of money. Data calculation is sort of off, right? You cannot calculate them anymore. It's possible. As long as it's there, the number is valid, then we do a data hedge. If it's a holiday or that stock is not traded, you don't have a valid quote, it's fine. We skip it. We don't trade that day, right? So you update as frequent as data allows you to update. Right? For the most liquid ones, I guess we update every day, right? For all the business days. For less liquid ones, you update less frequently. So it's a little bit more frequent than the second strategy, but we allow this sort of potential illiquidity. Right? It's not a perfect sort of gauge, but I feel like I want to accommodate the reality that sometimes there's just no trades or no quotes even. And in those cases, you just assume you just carry it over. Okay. And so that's how we calculate the P&Ls. Then we want to convert the P&L into a return number. There are different ways of doing it. I have to went back and forth. So I guess one way is to divide the P&L by the option price, maybe at the beginning of the option price, but the option premium is very low, right? For derivative trading, the required capital reserve could be much higher than the option premium, right? So I took a, probably doesn't matter that much for the general analysis, but I used the stock price as my scaling. We call this the return on notional. Right? Probably this is the conservative side, right? Normally on the desk you have a budget on Vega maybe, right? Budget on Vega is close to the option price, right? Budget on Vega, and then you also have a notional budget. No matter how you hedge, you have a notional budget. So we define it on the notional, the P&L over the stock price. So this is sort of a very conservative calculation of a return. And summary statistics, this is on the naked option, right? Yes, this is on the naked option. So since I divide the option return in percentage of the stock price, right? Suppose you want to do a translation, you said, okay, if I divide by the option price, how much it will be? So I calculate the option price. Roughly speaking, the option price is about 5% of the spot level. That is, if you multiply these returns by 1 or times 20, right? 20 times, you will get the return on the option price. Okay. So on average, selling call options doesn't make much money, 2 basis points per month. And selling put options make a little bit, 52 basis points. The difference is mainly, I think, a large part of it is driven by the data exposure and the fact that the stock tends to go up, right? When you short put options, you're long the market. And the standard deviation is 7 to 8%, roughly 8 to 9% maybe, right? And think of the option risk premium at about 5%. You sell the option for about 5% of the stock price level, and the risk can be about 8 to 9% of the stock price level. So it's a highly risky selling, right? You look at the percentiles, about 25% of the time, you make 5%, which means you make the whole premium, right? That's like you sell the insurance and the option exercised out of the money, right? You sell the option naked and they exercised out of money, you just collect the premium. But you also have 10% where you can lose about twice as much as your the premium you collect. So it's highly risky, and you have the large kurtosis and negative skewness. Right? And in general, selling put is even riskier than selling call because I guess the upward trajectory can be much larger. Your loss can be much larger. By selling a put, I guess the worst you can go is the stock price goes to zero. Right? So the selling call becomes a little bit more risky here. Now let's compare it with one-time delta hedge at initiation. Right? So in this case, the performance, the mean and standard deviation of the call and put investment are getting very close to each other. Right? I think in theory, if these are European options, put call parity, because of put call parity, I should get the same number. Right? So the number are slightly different from these two sides. Some numerical, some American, the bid ask and stuff potentially, right? So you make 30 to 32%. I think average is about 29 basis points, which annualize over 3%, right? And you have the standard deviation about 4.3%, right? About half of the original standard deviation by hedging it once, right?
So let me jump in with a clarifying question since
Okay.
it's about from Bjorn Rocker. So what are the moneyness and maturities of these options in the slides on table 8 and table 9?
Very good. Table 8 and 9 is the same table here, right? So I just add a table.
Okay.
So all across my slides, I'm using 30-day options. And the delta is close to 50 at the money options. That is, I choose one strike that's closest to the spot. Okay. Yeah. So,
and then from Dimitri, while he jumped in, so how should I think about the residual risk for these three hedging strategies over the options lives? Consider a stylized example. An ATM option becomes in the money or out of the money in a few days, and thus your delta becomes approximately 0 or 1. So if you do not hedge, you face a 50-50 chance of either no risk or risk of 1 share.
yes. So let's think about it. If you have a naked option, at the money naked option, I guess you can say you have the delta is 50, right? You do have the stock exposure. I don't call that primary risk, right? But you have that stock exposure that's probably dominating the movement. And after that, you will have these other exposures that we're going to discuss later, as vol, jump, that kind of stuff. But without hedging, the stock exposure does dominate. But what we're trying to say is if you can hedge the data exposure easily, then that's not the risk you are playing with in the options market. So when I say primary risk, I'm talking about later about the risks that we cannot easily achieve through the stock market. Does it make sense?
Yes. And one more question before I let you move on. Do you have an intuition or an explanation for why the kurtosis for puts and calls become very similar, going from strategy A to B?
Yes. So naked option, if you sell a naked call, there is a chance that the stock price can jump through the roof, right? So and you can have a large loss, and so this kurtosis can be large, skewness can be large. But when you have a delta hedge at the beginning, for European options at least, the call and put pay off. This is static position, right? You have a one call minus the say 50 delta of the stock position versus one put plus 50, right? Something like plus 50 of the stock. They become the same position, essentially the same position, right? How do I draw them? You have a hockey stick either this way or that way, but by putting 50 delta somewhere, you become this way, right? Like a straddle. You certainly have a straddle position. So the number should be exactly the same, actually. in theory for European options. But protocol parity violation, whatever, and maybe some of our filtering, we're not getting the number that close, but it should be identical. Does that answer the question?
Yes, and thanks. And I think we should let you move on because I see you're only on slide 9.
It's fine. I like these questions. It's very important. These are at the money, 50 delta, 1 month options, right? And actually, for the second question is also important because I use that to sort of check what's wrong with my number, why it's not exactly the same. So I find all our calculations are correct. I double check all the numbers. So there are some protocol parity violation, and these are American options, I think. But in theory, these numbers should be very, very close to each other. They're the same contract. Okay. And then when I do delta hedge, right? So when you do delta hedge, the risk is further reduced. When you do delta rebalancing every day, whenever you can, the risk is further reduced. And I guess I forgot to mention that. So in order to see the effectiveness, I define a variance ratio. That is 1 minus the variance of this hedged series divided by the variance of the unhedged series, right? So when you do one-time hedge, the variance ratio is about 70%. And when you do daily rebalancing, it's 90%. And also what's interesting is that maybe I shouldn't calculate the variance ratio this way, is that you see the variance ratio quite different, right? 75 versus 68. But this difference is not because of hedging effectiveness difference. It's because of the underlying difference. It's exactly the Stephanie's question in a sense. That is, after you do hedge, these two contracts are very close to each other, subject to numerical errors in a sense, right? Numerical noise. They're the same thing. So you get a different percentage simply because the naked contract of call and put have different risks. So the percentage looks different, right? So later when I do the calculation, I try to pull them together to get an average number. Okay. So to me, this variance reduction is quite effective. And when I and Peter did this analysis on S&P options, these numbers go to over 95%. Right? So it's quite high. To us, it's kind of surprising even, right? 95%. And also if I do it every year, it's just quite stable. So hedging is quite effective there. Okay. So there is also a ton of literature on how you do delta hedge, or how do you do the calculation, whether you do daily rebalancing or size-based updating, for example, whether you change the delta based on some other measures. All delta is just the Black-Scholes delta provided by option matrix, right? So these calculations are sort of super simplistic. Maybe you can improve on it, it's possible, but it just gives you a sense of how much risk you can reduce through this risk reduction, right? So 90%, right? Daily rebalancing, 70% for just one-time hedge, right? So here, trying to see whether these numbers are stable or not. So I did this variance ratio every year, pull the data each year. They're so very stable, right? And also I need to pull the call and put options together, right? Because in a certain year, if the market keeps going up, your put option can be in the end out of money, right, all the time. And then you actually see very little risk in a sense, but that's sort of very by chance. Right? So if I average them, you get average call and put investments and calculate the variance ratio. It's very stable over time. Okay. So earlier I said that this idea is important in the sense that it drastically expand the market, right? If you think about it, if you don't know this strategy, you just sell options naked, then the amount of risk, 8% or whatever, you gauge the risk, you convert it into $1, you have a risk limit, right? That limits your size. Now, given that you can reduce your risk, for the same size of transaction, you can trade a lot more, right? And by trading a lot more due to externality effects, you can be much more aggressive in your offering and maybe attract more order flows. And the more order flow you attract, you have some canceling effect even, right? So there's positive externality. So using this hedging method just makes you just can drastically expand your market making capacity. So I remember when I was looking at this, I went to one of these option exchanges to look at this quote size. You can see that one or two of the option making firms, I guess they're super sophisticated and they figure out the game. they're putting 5,000 contracts on each side, everywhere inside. So like those small market makers just cannot compete even, right? You put 10 contracts, 20 contracts on each side. And but these guys just put a lot. The reason they can do that is potentially they find out a good hedging mechanism and they can track the market quickly. And they just get all the orders away. Okay? So later we extend this dynamic data hedging idea to general, right? Dynamic hedging on any other risks through a slope matching, right? And researchers, this has been using the idea of option pricing in other areas. For example, you talk about real options, optionalities in investments. But I feel like the inside of dynamic hedging, that is using fewer instruments to cover a wider space, range of space via movements, right? Dynamic change, has many important applications as well for portfolio insurance, for example, or capital structure, right? So you can think of leverage. If the underlying can be traded very easily with liquidity, leverage itself doesn't lead to default, right? Default, if you can highly leverage, but if you keep rebalancing your position to the same leverage, you'll never default. Default is because of large jump movements where data hedge doesn't work anymore, or you cannot trade the underlying to maintain a fixed delta. So, but although 90% risk reduction is still very remarkable, there's still about 10% risk left. So if I convert this 2.6% risk to an annualized number, it's about 9% risk, right? For a 3% average premium per year, right? So the Sharpe is not very high, but there's still significant risk left, right? And so now if you think from the sort of the opposite perspective, right? If these risks, first we worry that we cannot hedge all the risks, but if these risks cannot be hedged effectively with the underlying stock, it also means that investors cannot take on these risks easily with this stock. So if you want to take on these risks, then you can go to the options market to do so. So in that sense, the option market can play an active role, right, or primary role in risk allocation. Right? So the question is, what are exactly these remaining risks? And how do you identify them and measure them? And how much compensation the investors asking about? So in this paper, we identified 3 types of risks, and sort of how do you say this? You sort of find more problems than answer the questions, right? Each risk you identify, there are lots of issues with it, right? For example, we think that data hedge, right? Data hedging cost, we think of this as a primary risk. It's sort of a somewhat weird risk source, but I think it's a risk source in the sense that, generally you think delta exposure is a derivative risk because you can take the risk from the underlying. But if the hedging cost is high, right? If the hedging cost is very, very high, then the derivative market can also become a sort of primary market for the data exposure itself. Right? In the extreme example, you can talk about electricity. You're saying electricity today is not the same as electricity during December, right? So there is a kind of, electricity is not that electricity, that issue. But even in general, even if you talk about the stock, when, for example, when the market has short sale constraints on a stock, you cannot really gain short exposure on the stock using the stock market, but you can gain it in the options market. In that case, options trading becomes the primary source of gaining that exposure. So, and the delta hedging cost is sort of like a proxy for how much you can turn this option market as the primary market for trading the delta exposure. Given that argument, how do you measure the trading cost? There are so many different measures, right? You have the Amihood measure, bid express, maybe trading volume, something. So we use this measure where essentially it's a variance to a volume ratio. In general, people think trading cost increases with volatility and also the size as a fraction of daily trading volume. So this ratio sort of captures that relative trading. If you have very small daily trading volumes, your cost per 1 million shares, for example, will be high. On the other hand, if the stock return is very volatile, then the cost tends to be very high too. Okay, but here we did some adjustment. We minus the correlation square with the market to sort of exclude the component that we can hedge with beta hedging. right? Suppose you have a stock with a 90% correlation with some liquid ETF, then I guess using the ETF hedge would be perfectly fine because it's super liquid and the trading cost is low, even if the cost for the stock is high. Right? So that's trying to adjust for that. The second one is stochastic volatility. Everybody talk about stochastic volatility, and the options market is a natural market for volatility trading. The question is how to measure the volatility risk, right? Volatility is not observable, and we're not even trying to measure volatility. We're trying to measure vol of vol, right? So we need to do some approximation. So use the 50 delta, smoothed 3 months 50 delta vol as sort of the proxy for a volatility number, and the measure is 1 month's historical volatility in log changes, okay, as the risk measure. So there, obviously, you can think of many different variations in either the vol proxy or the horizons of the estimates, right? Or some conditional forecast, right? You can formulate a forecast equation to generate a future vol forecast of the vol, in a sense. And then the jump risk. Jump risk tends to be sort of the largest concern for stock investments, or it's sort of you earn the largest compensation for bearing that risk. But measuring it itself is not as easy. At least we find it not as easy. So I used a very simple measure. We use kurtosis of the daily stock returns, okay, over the past month. I feel like it captures something, but not everything, right? It captures sort of the hedging issues associated with a month, but whether the past month translates to the next month or not is not clear. And also, it doesn't capture those rare, events that has not happened yet, but it's pricing options, right? But it's a proxy. So given these three, we also did some control variables, right? So I constructed two risk premium measures without knowing the source, in a sense. One is just using historical return as a momentum measure, right? If you think the option premium are persistent, then the momentum should carry on, in a sense, right? And Steve Heston has a paper recently on Lee and Heston has a paper identifying momentum as the driver of option returns. So it's possible if the risk characteristics are persistent, then the option premium will persist. The other one is more like a valuation, right? If you implied vol is like the price, if you forecast the break-even volatility, and that difference is sort of a forecasted risk premium, right? So these two doesn't really give us the reason why there is a premium, but I'm trying to use them as a control variable to absorb things that we don't capture through our three risk measures. Okay. So first, we did a cross-sectional sort of factor structure model, very similar to somewhat like a Baruch model on stock returns or Farmer Macbeth, right? These are option returns regressed against these characteristics, right? Common characteristics in the cross-sectional regression. And we standardize these characteristics. Specifically, I standardize these three characteristics in a slightly different way. Instead of demean it, I just deduct the minimum and scale by the standard deviation so that when HC is zero, when the standardized measure is zero, it means the risk is low. Hedging cost is very low, right? So it's that because these things are all positive, right? So I didn't centralize to the middle, but centralized to the minimum number so that when HC, VR, JR are all very low, that means the underlying stock is very liquid. There's no volatility risk. Vol doesn't change much. There's no jump risk, right? So it's like that measure. But for these two risk premiums, I standardize them the standard way. Okay. So with this standardization, then the intercept has some meaning, right? The intercept essentially is the expected average return when the underlying stock is super liquid and no vol risk and no jump risk. Right? So I can test that sort of hypothesis. And I also expect the expected returns to increase with all three risks. And the intercept estimates indeed is very small. Remember, the total average return is about 20. This is only 1 month return. Each month is about 29 basis points. Right? So the remaining here is 6 basis points. It's no longer statistically significant. And I also computed annualized Sharpe ratio to sort of give a sense what they are. So the intercept is very small, but the most interesting is the three hedging risks, right? So they are all highly significant, and the most significant is the jump risk. Right? After controlling these risks, the momentum effect is still has some significance, but it's small. And the volatility risk premium, once we control the risk, it probably reflects more of the valuation effect, right? Mispricing effect, I think. So we also try to do a sort of intertemporal test. That is, you measure the average risk levels or cross section, right, and regress on the factor portfolio returns. So the hypothesis would be that if I create a hedging cost factor portfolio, then that portfolio return will vary with the average hedging cost variation over time, and the vol risk portfolio will vary with the vol risk over time. And that turns out to be true, right? So I run regression against all these risk measures, but the loading is mostly on the diagonal terms. Right? The vol risk portfolio loads on the vol risk, and jump risk portfolio loads on the jump risk. So these are the sort of main results, and we did some tests. For example, um, we constructed many different return series with different hedging. The main analysis is based on one-time data hedge. If we do it on daily data hedge, then the t-stats are higher, but the estimated slope estimates are about the same. Okay, and we also went through the other maturity and delta baskets. They're noisier, but the hedging effectiveness actually increases at longer maturity because the data doesn't vary as much. So one-time data hedge becomes effective even more. At a one-year maturity, just hedge it once, you can reduce 90% of the variance. Okay, so the asset pricing, because of these effects, the hedging cost effect is smaller for longer dated options, but the volatility and the jump risk, their pricing is still there. Okay. But this also raises many questions, right? We said, okay, we're using the option market as a separate market, and you can take on risks that are different from the stock market. But for each stock, there are many, many options across different delta and maturity buckets, right? So their risk exposures are different. So then that raises a question on how should we analyze them? I'm not quite sure. I'm just asking these questions. Should we pull them together and then control their different exposures, for example? That's like an integrated analysis. Or should we create a specific market for a specific risk, in a sense, right? As the money vol is more like a straddle trading, say that's a vol market. Should we create a risk reversal, for example, for the tail difference trading, or calendar spread for some volatility term structure effects? Right? How do you analyze their return behavior? Do you analyze at the option contract level, or forming this combo to highlight the risk level? Right? Do you put them together or separate them? That's the question. I don't quite know. I feel like currently I'm sort of thinking of the last one is probably the better way, right? That is, you single out the risk source and then you do cross section across different stocks. That's probably where we are. And that's where we are. Right? We find delta hedging it can be very effective in removing the risks. I feel like it's a big contribution. The Black-Scholes model is the biggest contribution, I think, in the literature. But despite that, the option market plays important roles in risk allocation. And for our analysis, on top of no arbitrage pricing models, I feel like we need to understand what are the risks that investors want to take using the options market, right? That they cannot take from the other market. Right? All markets are linked. I understand that, but they also have their own unique roles. What are their unique roles? And what are the unique risks you can take with this market that you cannot take as easily in other markets? And how do you price them? We did somewhat work, but I feel like we raised more questions than answered. Right? It's not much of a one innovative idea, but rather just try to understand this market better. I feel like I've been working on this market for a long time. The longer I work in this market, the less I feel I know about it. Still very much confused on many of these risk exposures and what do you do as an investor to sort of nail them down. So, and I'll stop here and looking forward to your questions.
All right. Thanks very much. So right now, I'd like to invite anyone who wants to ask a question to make a comment to please go ahead and unmute yourself, and ask your question orally using your microphone. So now's your chance to unmute yourself and ask your questions or make your comments.
Taylor, and it's Peter.
Yes. Good.
Nice talk. And I have a comment about the static delta hedge.
Okay.
That was 183. If you go back there, could you scroll back to the slide where you show the three types of hedging?
Okay. So we're here, right?
Well, yeah, that's fine. So this is good. This is great. So, okay, so we just compare, I just want to compare, well, I want to talk about B. So just to get into the details of B, you need to, let's say, I'm guessing you're using the Black-Scholes call delta and put delta.
Yes.
And that you need to supply a volatility. And I'm guessing you're supplying the implied vol of the option at the time. Is that right?
Yes. Yes.
Yeah. So I think I can explain like why there's a slight discrepancy between call and put when, let's say, in theory, like you said, they're supposed to be the same. So I think that, I think the issue with that calculation of delta is it ignores the leverage effect. So there's a well-known easy fix to deal with, the fact that volatility probably depends on stock price. And, you're still delta hedging with the stock, but you change the delta. So it's not simply what you're doing, but there's a correction, which is vega times the covariation of, of vol with spot. Are you familiar with that?
Yes, I know what you're talking about. Yes.
Yeah. Okay. Right. So it might be worth thinking about, adding that slight correction in the one-time delta hedge to see if it removes what little differences there are here.
Okay. So two comments on your. I understand that. One is whether using a sort of big correlation correction, right, can improve the data hedging effectiveness.
Right.
It's very hard to do. Very hard.
Well, let's say. Okay, I would use correlation negative 0.7. Okay, like
yes, that's the issue, right? Some for index maybe 0.7 is because of the experience you with the index, right? For single names, that correlation can vary cross-sectionally very much. It's not clear that you can use a total delta, the so-called total delta hedge, to improve. That's one point. The second point is it doesn't affect the difference here because this is the same strike and maturity, right? I know these American options, like if they're European.
Yeah, but what if the model is not Black-Scholes? Then
it's fine. I'm just saying that this hedging exercise doesn't depend on how you calculate delta. Even if you do vega correct,
it does. No, I don't agree. I don't agree. Like, I think if you have the wrong model and then you try to eliminate delta with the wrong model, I don't think you eliminate delta.
Okay. So you're saying put.
Yeah, I'm saying you're thinking of put call parity. I know, but put call parity, let's say in the model context.
Okay, I got it.
Yeah.
Yes. So because you are saying delta is 0, you go back to naked.
Yeah, like you're thinking that you're like a way of saying it is.
No.
A model. The role of a model is to like split the exposure into like an odd and even part, so the odd part is like the delta and the even is like the gamma or vega, whatever. And that's so if you get the odd even decomposition wrong, you're not going to remove the odd part.
I got it.
Yes. Okay.
Yes, because I'm coming back to this equation here. If delta you miscalculate as 0, then you go back to the naked option.
Yeah.
But I guess you cannot be both 0. It's 1 minus.
Yeah, they'll both be slightly off from 0. So they'll be, No,
actually, I don't agree. But yes, you can do the calculation. Suppose my data is so wrong as 0 for call, right? For call is 0, for put it would be 1. Because I'm using the same formula, right? 1 minus D1, like ND1 or 1 minus ND1. So if
Yeah, you
one
are.
is 0, the other is 1, I think to the conversion.
No, so we can use this equation you had right here. So for O, let's use anything other than Black-Scholes to calculate the delta. And then for delta, let's use Black-Scholes like you did. And just tell me if you get 0 stock price exposure.
Okay, so the key is whether you have the put and call has the 1 minus of each other or not. If you have 1 minus of each other's delta, then it'll cancel out. Right.
No. so all models will give the deltas being 1 minus each other. But
okay, that's what I'm saying. Then my calculation is the same because you have a call, you have a delta, whatever your delta, just a random number, and then you have a put, you have a 1 minus the call delta. As long as you stick with 1 minus call delta, then the 1 and the put combine to give you the call. So you are left with the same delta. The delta is wrong, right?
No, I mean what you think of as the 0 delta call actually has, let's say, a slight positive delta, and then what you think of as the 0 delta put actually has a slight negative delta. So it's true that the call and the put summed together have 0 delta, which is I think what you're saying, but it's not true that you've achieved delta neutrality for each of those option positions.
I agree. I may not achieve delta neutrality. But I'm saying that these two P&Ls will be the same. They would have the same wrong delta exposure. But yeah, we can do the derivation afterwards.
I mean, I'm saying that you're sort of bleeding into the no hedge case a little bit, and that's what's causing the slight discrepancy between the call and the put when you're thinking they're both delta neutral, but they're actually
no. I don't. Suppose my data is wrong. My call data is 0. So my call data will be the negative.
Which call? Okay, so there's 2 deltas for the call. There's the actual delta that the market is using, and then there's the delta that you're using.
I'm using the wrong one. The true delta is 0.5. Let's say, okay.
Okay, that's fine.
My data is 0. Okay. My call data is 0. That means my put data is 1. Right. I don't care about the real delta. I don't know the real delta. I just say, let's say we know the real delta is 0.5. I'm just using the call delta of 0. Then my put delta is -1, right? So that's fine. If I use 0 and 1, the call would be naked. The put will be converted into a call. It'll be the naked call return. Because I'm using call, I'm converting the put into a call, right? Because I'm just saying put plus stock minus 0, right? I'm not hedging anything, I know. But I'm converting these two contracts into the same contract.
Okay, so I mean, let's just go to extremes to see our slight differences. Suppose the true vol is actually 0. Okay.
Okay.
And the market is using an implied vol, not 0.
Yeah.
Okay. So, like let's just say interest rate 0. So the first term is just going to cancel because the true vol is 0. Remember I said that?
Peter, let's say this, right? So this is a good exercise for people to do. That is, you use a wrong delta and see whether the call and put will convert in the second case. I feel like it's good to give it to people to do this exercise. I could be wrong. It doesn't really matter. It's one of these things. Right? They're not matching anyway.
All right.
Yeah, Liuren, your answer to Peter, I think it kind of locally makes sense, but as soon as you're going to go out of your initial state, then these things will diverge.
Not really. I write down the like my calculation, my code. The difference, you add s in the beginning, add s in the end, because my constraint is I said my put delta equals to 1 minus call delta. If I stick with that, then I'm just doing a put call conversion, right? Because I can pull out the 1, convert the put into a call.
Okay.
Right. So
what you're actually doing, you're not
obviously if you say
no. What you're actually doing, Liuren, is converting both into. What you're actually doing is trying to convert both the put and the call into a straddle. That's what you're trying to do, and you're trying to make it a 0 delta straddle. But I think that if you have the wrong model, you're going to create a straddle-like position. It's just that there'll be a slightly different delta at the current stock price.
I know. I'll be sliced in the wrong way. The same way for both. I'll convert my put. If I assume my call delta is 0, but the call delta is 50, I would convert my put into a call. So for both cases, I don't have a straddle. I have two calls. Right? The call is negative because it's 0 delta. The put, I'm assuming, has delta of 1. If it has a delta of 1, I minus the delta, I essentially convert it into a call, right? So I know I'm converting them.
Okay, but that's not what you told us you're doing. Okay, like, I mean, if I take you literally as to what you're doing with the one-time hedge, you're not trying to turn the put into a call. You're actually trying to turn the call into a straddle and the put into a straddle. Do you agree with that? No. Okay.
Yes,
well,
that's our target, but I could be wrong, as you said. My delta could be wrong. I won't be able to do that, right? If I'm wrong, but I'm converting them to be the same thing because I'm using 1 minus delta for put. You know, if you set the delta of call a certain number, I'm setting the put delta to 1 minus that number. If that number is wrong, but my put call conversion is still right. Anyway, it's like a simple exercise. You write them down, you see it. I know I could be not neutral. That's possible, right? Because delta, who knows what the real delta is. But I do have a conversion here. It's 1 minus, I'm saying the call delta equals to 1 minus the put delta.
So your point is, okay, so you have the wrong delta. You're not converting them to 0 delta straddles, but both straddles each have a delta of 10.
Yes.
So your point is that they're
I'm
the same.
converting them to the same thing. It's like,
all right.
It's in the code, it's like a numerical equivalency there. Unless you're saying the put delta and call delta, they don't sum to 1 based on my calculation, then the two numbers will be wrong. If they sum to 1, then I'm doing a conversion. But it's fine. I can always do a Vega whatever adjustment and see what the number changed, right? So what I'm interested in is whether you can reduce the error a little bit more with some adjustment, right? That's useful. It's very hard to reduce the error. I feel like that's a research topic by itself. That is, how do you sort of pick the delta or something else to do hedge effectively? It's very hard to do in practice. Given the model, we know a hedge. In practice, you don't know the model. How do you reduce the risk? It's not that clear.
So Liuren,
version in the stock, whatever, do you do? I think Goldman did some research. They said, let's hedge half delta because tomorrow the market is going to move. Maybe it'll come back something. But very few people dare to do that. Right? The risk manager probably won't allow you to do that either. So it's a very hard thing to do.
suppose you compute the delta empirically by regression, Liuren. So you take price changes in the option and then you regress it locally onto price changes in the index or the futures.
Yeah, is that stable? The question is, right? It's stable in the sense that the option, we cannot follow the option contract. I guess you interpolate. Is that right?
You can look at, well, I agree. You're going to have a problem if you look at very illiquid stocks, but if you look at SPX, I think you'd probably be fine.
So you are interpolating, right? Because each day you have a fixed strike option. Every day their exposure is changing, so their sensitivity is changing.
Yeah, but you can do it intraday.
Okay. But intraday, I'm not sure the movement is the same. You could. I mean, the desk on the desk we tried that thing. Locally intraday, the movement is very close to local vol, but over days, when the move is a large jump or something, it resets. It's very hard to nail it down. It's a good question though. If somebody can figure out like the right ratio, right? Total delta in particular, that is, you want to use stock or index to hedge or weigh as much risk as possible. Doesn't need to be the delta per se, right? If it's vol, if it's correlated local vol, you want to hedge as much as possible. It's just finding the right slice is difficult. We tried empirical stuff. Very difficult to make it stable. If you find a good way of doing it, because this is for large institutional trades, this can reduce a lot of cost, right? It's a very useful thing to do. I haven't found a way that can improve above Black-Scholes in a very significant way. If you calibrate the model, in some way you can do it, right? Sometimes you think Black-Scholes model or some other models, but it's very difficult to do. And who is that German, right? Have this thing, it says, oh, it changes. You estimate the relation. At this point is local vol, at that point is not local vol. So that adjustment, sometimes you adjust positive, sometimes you adjust negative, right? And you cannot also adjust based on the slope either. Sometimes the slope, the skew is caused by jump. The adjustment is the opposite when it's caused by stochastic vol, like by leverage.
One of the things that is this is my empirical suggestion would work in a pure Black-Scholes world where there's no other risk factor under the
Yes,
stock
exactly.
price.
Yes.
So the fact that it changes over time and it becomes, as you say, unstable, it's just evidence of the fact that there are other things that are moving around in a way that you didn't predict under the Black-Scholes model, or you didn't predict.
Exactly.
And so, you know, that's one of the things. So you could include additional factors, not just the price, right? You can hedge with VIX futures or some other pure variance instrument, like a variance swap or whatever. And so then the question becomes, you know, like, does this work? I mean, you're asking an empirical question in the paper, right? What is the best way to hedge?
My understanding is what the guy won't want to do is to try to remove as much as possible risk using the underlying because it's liquid. Whatever left, you try to do it more in a sort of proactive way. That is, do you want to take it? Do you want to wait for order flow? Right? It's less of a mechanical thing. Normally they don't want to think too much about the direction exposure. Just hedge it away. If you know how to hedge it, just hedge it away. The remaining one becomes more of a decision. Do you have a view, or you want to take the premium? So most of these guys want to take a little bit short vol, maybe by how much? That's the question.
Okay, other questions?
Can I jump in? So people here focus on delta a lot, but I think it's also important to focus. You're looking at a very specific trading strategy in a very specific way of delta hedging. I'd like to see how this 90% number varies. So for example, if I take in the money option, obviously delta hedging will kill 99.9% of variation. Similarly, if I look at one month straddle, delta hedging will eliminate only 60% of risk during the first week, but will eliminate 99% of risk during the last 3 weeks or so. So I think it's interesting to look, generalize it to other trading strategies if possible.
Yes, very good. So for longer term, a good question. For very long-term option, as you said, if you had a one-year option for 1 month, it's very effective. You don't need to update your delta even, because for a one-year option, the gamma is very small, the delta doesn't change. If you make them neutral, it'll stay neutral for a month or so, right? So delta hedge by once, you can remove 90% of risk. For out of money option, let me quickly check. I did have monthly option. I forgot the 25 delta. I did a 25 delta one. As you said, the variance should go down. I don't normally look at in the money option because you do the put call parity, just cancel that part anyway, right? So where's the variance reduction? Yes, for 25 delta, the variance reduction goes down a bit. Like for one-time data hedge in the middle maturity is 70%. 25 data is about 50%. I'm talking about 25, the out of money option, right? So that's true. And if it's far out of money, it's very hard to calculate, right? Most times they are going to be out of, how do you say it? Most times they're going to be out of money anyway. It's like, right? If you don't hedge, you essentially collect the risk premium and nothing else happens, right?
So let me make one observation. I have an observation and a question. The one observation is that, you know, this idea of focusing on the risks that are difficult to hedge is not completely novel, right? And the Garlino, Pedersen, and Potishman do it with their demand-based option pricing,
Exactly.
where you can assume there's initial delta hedge, and then they focus on what they call the unhedgeable risks, which they operationalize as vega and gamma. I mean, they have a different framework where they're not doing dynamic hedging. They do have a utility-based framework with normal negative exponential framework, but they have some of the same idea. But then a little bit different from related to that, my question is, so should I think about this, should I think about your risk measures option by option or stock by stock? Or should I think about, the covariance of Vega risk with Citadel's entire book, across all underlying names? So how should I should I think about these risk measures as covariance with Citadel's portfolio, or should I think about it option by option?
Very good, very good. I mean, the first paper, I feel like that's sort of the direction. If we want to do some theoretical work, I would like to push in that direction. That is, before the paper you mentioned, demand-based pricing, we're talking about no arbitrage pricing, right? So if we want to focus on the after part of the no arbitrage, right? So that's probably where we should go. I don't quite know how to expand the theory along that side, but we are essentially, yes, along the same lines. We want to actually not only sort of exclude the no arbitrage part completely and focus on the residual part. I think in that paper they call it inventory risk, whatever, right? Whatever is your left. Right? The second question is very interesting. Actually, I think is what I'm struggling with. My current thinking is to focus, if you focus on the same delta maturity bucket, say 1 month at the money, then their risk exposures across different names are close to each other. So because they're close to each other, I don't need to measure the exposure as much. Then I guess I'm less worried about covariance. I just say do cross-sectionally, I just get the risk magnitude. There is a covariance term, there's an exposure term at least. I'm ignoring because I'm saying they're the same. So if I pull in all the options together, then I cannot have them have the same loading on the same vol risk, for example, right? Because there's a Vega or something. But in that case, I don't even know how to link that to the jump risk, for example, or the hedging cost stuff. Right. So I'm feeling that picking one bucket and do a cross-sectional analysis, then you can just use one risk measure. You can ignore the sort of exposure a bit better. In terms of covariation, it's a good question, right? Because our traditional theory says that if you can diversify, it's not priced, right? But the counter argument to that is, and that's an empirical test actually. For example, one thing we can do is on the volatility risk. For model here, for example, for the intertemporal thing, for vol risk, I use the average of the vol of each name. Should I use that, or should I use first do the average vol, that is the implied vol average across all names, and then do a variation, right? That's more like a diversified portfolio. Suppose you have a portfolio of options across different names, different stocks, right? You have Vega exposure on these different names. Some of the vol will go up, some of the vol will go down, right? Your exposure is the net, right? It will be more like an aggregate vol, I think. But the question is whether diversification is the sort of the cost-effective way or efficient way of reducing risk or not in the options market, because the transaction cost is so high. So in that sense, it's just like the stock. Do we price the total vol? Do we price the idiosyncratic vol, right? So for private firms, we said we price the total vol because it's not diversified. So I'm not quite sure whether we are pricing the average risk or we are pricing the portfolio risk in a sense, right? That is, do we do the covariance term? Or we're saying no, actually, because that portfolio itself is so hard to construct, costly to construct. Any risk you take on that particular contract, right, is worth considering. The diversification is not a costless endeavor. But these are very interesting questions, right? Once you get to this area, essentially all these questions we have considered for stock market, you can consider here. And with all the constraints are essentially telling you how to think about it.